In 2026, your home's value is being held hostage by a silent market distortion. While interest rates hover at 7%, a hidden inventory bottleneck is artificially propping up prices, trapping buyers in a cycle of overpayment. You are currently walking into a financial ambush if you ignore this specific leverage shift before finalizing your next purchase. Understanding this exact mechanism is the only way to avoid losing thousands of dollars during your transition. Protect your net worth, keep watching. The final strategy I am sharing acts as a hedge against market volatility, and it is something you can implement before you even speak to a real estate agent. Grab a glass of water, get comfortable, and let us get into the mechanics of why the housing market is acting the way it is. To start, we have to look at the baseline. For years, the narrative was simple. When interest rates go up, home prices go down. It is the classic textbook response. Higher borrowing costs reduce the number of people who can qualify for a loan, which theoretically should cool down buyer demand and force sellers to drop their prices. But as we approach the middle of 2026, that relationship has become distorted. We are seeing record low inventory levels that are effectively acting as a floor for property values. Think of it like this. If you currently have a mortgage locked in at 3% from the pandemic era, and you look at today's rates, your monthly payment would likely double if you move to a new home. That is a massive financial deterrent. You are effectively trapped in your low rate mortgage, and you are not alone. This phenomenon is known as the lock-in effect, and it is the primary reason why inventory remains so painfully thin. Does that sound familiar? It is the invisible wall keeping the market supply starved. Because sellers are not listing their homes, buyers are fighting over whatever crumbs are left on the table. Even with rates hovering near 6 or 7%, this lack of choice keeps competition fierce in desirable areas. Now, here is where it gets interesting. When you look at regional data, you notice a divergence. In cities where new construction surged between 2023 and 2025, price growth has plateaued. In contrast, older suburban markets with zero new inventory are seeing prices creep upward. Why? Because the supply shortage is local, not just national. When a buyer realizes they cannot find an existing home, they turn to new builds. If you want to identify where your property value is heading, stop watching the national headlines and start tracking the housing starts in your specific zip code. That is your first easy win. If there is a high volume of permits being pulled nearby, you know that a supply wave is coming in 18 to 24 months, which will eventually stabilize prices in your neighborhood. If your neighborhood has no room for new development, your home has a distinct scarcity premium that will hold up regardless of where interest rates go. If this is clicking for you, hit subscribe. I release deep dives like this every week to help you navigate the economy without the noise. Now let us level up to the second dynamic. You have to consider the long-term impact of household formation. By 2026, the largest cohort of the millennial generation is squarely in their peak earning years. They are tired of renting, and they are tired of their small starter apartments. Even with the higher cost of debt, these buyers have built up significant equity or have saved aggressively. There is a psychological threshold at play here. After years of waiting for a crash that never arrived, many of these buyers are finally throwing in the towel on timing the market. They are making the calculation that a high rate today can be refinanced later, but the price of the home they want is only going to move higher as more people enter the market. I had a friend, Mark, who spent 3 years waiting for the Fed to slash rates back to 3%. He lived in a cramped 2-bedroom rental, watching his savings lose purchasing power to inflation. By the time he finally pulled the trigger in early 2026, he paid 10% more for a home than he would have 2 years prior. He was frustrated, but he ended up with a house that fit his family. He realized that waiting for the perfect financial environment was costing him more than the interest payments ever could. That experience is not unique. It is happening across the country. The demand isn't disappearing. It is just latent, waiting for the right moment to strike. Okay, remember how I said the best strategy was coming? Here it is. This is the one I've been saving for you, and it has the power to change your entire financial outlook. It is the concept of the assumable mortgage. If you are buying a home in 2026, you should be hunting for listings where the seller has a government-backed FHA or VA loan. These loans are often assumable, meaning you can take over the seller's existing mortgage at their original, much lower interest rate. Think about the math. If you find a home where the seller has a mortgage at 3.5% and current market rates are at 6.5%, you are essentially saving thousands of dollars every single year in interest costs. You are inheriting the lower monthly payment, which creates a huge advantage compared to every other buyer in the market who is fighting for a new loan at current rates. It is the ultimate secret weapon for the savvy buyer. It turns the market shortage into a feature rather than a bug. You are no longer competing on price alone. You are competing on your ability to structure a deal that provides long-term value. Let that sink in for a moment. Most people are so focused on the headline rate that they miss the opportunity to find a mortgage that has already been discounted by the seller's previous success. Once you see the market this way, you can never unsee it. It shifts the power back to you. You are no longer a victim of interest rate cycles. You are a strategic player who understands how to leverage existing assets to your benefit. So, there you have it. You now understand the supply constraints of the current market, the demographic pressures driving consistent demand, and the specific, actionable strategy of finding an assumable mortgage to protect your cash flow. That third method alone is worth more than the first two combined. It changes the entry cost of your next property in a way that traditional financing just cannot match. If you found this helpful, share it with a friend who is currently looking for a house. Sometimes, all it takes is one conversation about the right strategy to change someone's entire financial trajectory. Subscribe if you want to stay ahead of these trends, and let me know in the comments if you have ever looked into an assumable loan. I am genuinely curious to hear what you find out there. I will see you in the next one.